Good morning, everyone. Probably some returning faces here, and glad you're back with us. My name is Zach Hurst. I'm with the Trust Company of Tennessee. My counterpart, our head of retirement plan services, Adam Davies, is on the screen as well. And thankfully for you all, it's not just the two of us. We have our expert coming in from JP Morgan, Kelly Hahn, who is on video as well. Kelly is executive director and a defined contribution strategist at JP Morgan. And Kelly, I think you've been there 14 or 15 years. Is that right?
Yes, long enough.
Yeah, that's right. That's right. But Kelly, as you know, on this call, primarily the audience is going to be plan sponsors or people who are involved in managing their company's 401k plan. And so I think this is a really important topic we're covering today, which is participant success through behavioral finance. And this is a way that you and Adam can coach people like me who administer plans and people like the participants on the call who are plan sponsors on some strategies we can look at to try to enhance our participants to give more or just achieve their goals through the plan. So I'm looking forward to this. Before we get started, a couple of housekeeping items. My screen's a little bit different than those who are on the call, but somewhere you're going to see a questions box. So feel free to load questions or ask questions into that box. I'll try to pick up on those as Adam and Kelly are talking and going through this, and we'll try to address those as they come in. But certainly we'll leave time at the end for those if we can't get that. Also, we're going to have 3 poll questions throughout this. I'll introduce those as they come. Joanna's behind the scenes. I'll reference her name a couple of times. We'll launch those, let you answer. They're just kind of fun and interactive, and we'll look at the results of those. So with that, I think we are ready to get started. Let me, of course, I'm forgetting to click through, but all it is our faces. So we will get to the content. And Kelly, tell us a little bit about why we're talking about this.
Sure. I think when you ask somebody what you want to do in terms of how you want to manage money or what your goals are, that can often be very different from the way they actually behave, their actions versus their intention. So what we are primarily focused on at JP Morgan in understanding participant behaviors is through the empirical data that we have to understand their true actions. So as you can see, we have millions and millions of data points that we can analyze to understand the entire life cycle of how people go through saving, transitioning into retirement, and how they end up behaving in retirement. So the insights that I'm going to share with you today are based on the real actions that we see through the data that we have on this page. And just to put it out there, the data is completely anonymized. I know there's a lot of I don't know, skittishness around, people having my personal data. I often get kind of like nervous that, well, somebody has my data, but everything that we analyze here is completely anonymized, and all of the privacy is really, really well protected. And of course, we honor that, and we are committed to continuing to do that.
Great. Thanks for that. And we will get into the content now. And Adam, we're going to look at participant biases. This is actually really interesting. I was going through, I wish I could say I was going through this 2 weeks ago preparing, but truly it was this morning. But I really like these and looking through these. So tell us about what we're going to be talking about in the first section of this.
Yeah, so there's so many different things that impact the way people think, how they make decisions. And specifically, we're going to kind of look at human nature and how can you make that work towards people saving for the future, for their retirement, rather than against them. So a couple that we've highlighted here, anchoring bias, framing bias, recency, overconfidence. None of us suffer from that, of course, loss aversion, and then status quo. So with each of these, we're going to talk about what they are, maybe some tricks you can employ in your retirement plan, and how we work with our clients to help overcome some of these.
Yeah, and with that, let's jump right into those and start with anchoring. Again, there'll be 6 of these, but we'll keep them pretty brief. But again, they're really interesting. So Adam, take us through anchoring bias.
Yeah, so this could take many different forms. I'm sure we've all seen this when we've gone out shopping, and perhaps you see that item that says originally $100, but then just for today, it's offered for the special low price of $80. You get a 20% discount. When you anchor them around that higher price point, then anything that comes in lower than that, of course, looks like a deal, and it's that much more appealing to buy. So when you're looking at anchoring within your retirement plan, a number that people are often drawn to is the match. And really the more important consideration is, are you saving enough in total? A lot of people pinpoint that number somewhere between 10 to 15% of your pay. And so you can use your employer match to help anchor people in the right way to try to meet that 10 to 15% goal. So we could take one client, perhaps they have a match of 100% on the first 3. And so participants might look at that as a suggestion or recommendation, saying, hey, I only need to save up to the full match. If I put in 3, the company gives me 3, I'm saving a total of 6. That could leave them a little bit short of that 10 to 15% that a lot of people recommend. So what you as a company could do, or what we can help our clients do, is maybe consider something like a stretch match. So instead of doing 100% on the first 3, maybe you do 50% up to 6. So you as the company are still putting in the same 3%, but you're encouraging the employee to save a little bit more. They put in 6, they get 3. At the end, they're at 9%, and they're a whole lot closer to that 10 to 15% recommendation.
Adam, we had a client in, I'm in the Chattanooga market, Adam's in our Knoxville market, but we had a client down here that was acquired a few years ago by a larger company, but we were retained as advisor on the plan, and they had to go exactly what I think is what you just said. They were 100% of the first 3. Because of the new plan, they had to go to 50%, basically requiring the participant to give 6% to get the full 3. And going in as advisor, I want to say it was 100% of the people that went from 3 to 6 of those who were participating, which was probably 95% of them. So I've seen it work firsthand, and so that's why I found this pretty interesting.
Yeah, and that experience really highlights this whole anchoring bias, and that JP Morgan actually put out a really great study a couple years ago that said that a lot of people look to their company for guidance in a variety of different forms, especially their benefits. And so that study revealed that a lot of people actually think that what the employer is setting the match at is an implicit recommendation of how much they should be saving to have a successful retirement. So that's just kind of a neat takeaway.
But can we trust JP Morgan?
Of course.
Well, we'll see at the end of this session.
Exactly. Right.
Well, I think this point is,
yeah.
It's really, really important, especially now, because if you look at this chart, we're looking at the historical annual savings rate going all the way back to 1960. So over the last 6 decades, how we as a nation have saved. And if you just kind of glance your eye over the shape of the bar, you could see that we continue to save less and less and less. I think this is sort of somewhat talking to our generational attitudes about how we've gone about saving. Our parents saved a lot more, our grandparents saved a lot more, but our economy is sort of shifting to more consumer-driven, spending-related economy, and you see that. Except for the 2 large spikes that you see on the right in 2020 and 2021, the savings rate really soared. And as you probably guessed it, they coincided with the stimulus paychecks that were handed out by the government. But what is really troubling is when you look at what happened in 2022, the savings rate has gone down to the lowest level that we've had in a long while at 3%. Now we're facing the possibility of maybe a recession, and if it happens, is it going to be hard or is it a soft landing? At the risk of an economic downturn, people not saving much to encounter the distress that we may feel as an economy, that's a very, very difficult thing. And then if you go to the next page, you can see the same behaviors that we saw as a nation from the average savings rate happening specifically within defined contribution. And that's what the chart over on the left is trying to illustrate. We've looked at this data in terms of the average savings rate over the last 2 decades, and that's what the going from top to bottom is showing you, from the oldest study to the most recent study. Without going through each icon, but if you look at the visual illustration, you can see the person being pulled down to the bottom left. And what that is showing is that the average savings rate within DC has come down over the last 2 decades, and people are saving without the match anywhere between 5 to 6%, well short of the 10 to 15% that people need to be aiming for. I think it's probably closer to 15% because we just consume more and more. So if you want to maintain the similar lifestyle, then you just need to save more in order to pay for that. part of what we're seeing within DC in terms of the average coming down has a lot to do with the auto enroll that has been so helpful from the Pension Protection Act of 2006, where it increased the number of people who are saving towards their DC, but the auto enroll has been done at a relatively low number. If it's not accompanied with auto escalation, then people are being anchored at a lower savings, as you're seeing anywhere between 5 to 6%.
Kelly, just curious about this. The bottom left you mentioned and how our trends without the match are coming down in terms of how much we're saving. Do we know if that's attributed to the fact that more and more companies are offering a match? Does that make sense?
If they're offering a match, then I think, and if people are taking advantage of it, then I think you should see something else on the other side, right?
Yeah.
I think a lot of it has to do with auto enroll being done at a relatively low number, and that's sort of pulling the average down. The auto escalation can really help, right? If you're just automatically escalating them, but not many people had done that. A lot more companies are doing that now, but it wasn't done so widely historically.
Got it. Okay, thanks. All right, so that is anchoring bias. We're going to jump into the framing bias, the second of these biases that we spoke about a few pages ago. And Adam, talk us through framing bias.
So you could kind of think of this one as, are you a glass half full or a glass half empty type of person? So regardless of which way you look at it, the glass is only at 50% capacity, but do you frame it up in a positive light, glass half full, or perhaps a negative light, glass half empty? And so how you can help your participants through this framing bias is, when you're talking about how much should you be saving, a lot of times providers will have a form like what you're seeing on screen, a contribution election form, where you're essentially asking them to check a box, how much do you want to save? Now, there's always an option to put in an other, and you can write in whatever percent you'd like. But you could take the example on the left, where again, perhaps that company has a match of 50% of 6. If you frame it up as your options are 2, 4, or 6, you're always going to have a certain segment of the population that falls under that good, better, best framework, where whatever the option is, they're just going to pick the lowest because that's in their nature. That's just how they make decisions. You're always going to have people that are going to select a premium option. When you go to the gas pump, some people always pay for premium gas, and then you're going to have some people that fall right in the middle. So how you can help people overcome that is, the example on the right, where select the lowest option as the one that takes full advantage of the match, and then have options that go up from there. So this could just be another way to frame that conversation of how much should I save, with the end goal of trying to reach that 10 to 15% target that should help them replace their paycheck in retirement.
And I want to get to the next page because this is I found this, Adam, to be a really useful tool in my advisory role, going out and speaking with participants, because this does a really good job of illustrating the impact of putting more and more dollars to work. So talk us through this graph.
Yeah, I don't think we've done a great job of an industry of really making saving for retirement tangible. So a lot of times we'll say, hey, you need to save 5%, you need to save 3%. And people are saying, well, yeah, that's great, but what does that actually mean? How does that impact my take-home pay? What does that mean I can't do because I'm now saving for retirement? And then what does that get me in the future if I do make that sacrifice? So what we really try to do is illustrate that on a per paycheck impact. So we say, here's a hypothetical salary range, and if you save 5% of your paycheck, that equates to your paycheck going down by about $25. Now, that's a sacrifice. That's money you could be spending elsewhere, doing things for your kids, your family, perhaps saving up for a fun trip in the future. And so what can you get over long periods of time, 20, 30, or 40 years, if you make that sacrifice? So we've found it's been pretty palatable if you say, hey, if you can afford to reduce your paycheck by just $25 in exchange for nearly $500,000 40 years down the road, a lot of people are willing to make that trade-off. So I think framing it up in a per paycheck impact makes a lot more sense than just saying, hey, do 5%, do 10%, because people can't really connect and understand, how tangible that is.
Right. And Kelly, we're going to talk a little bit about RMDs. I'll let you guide us through this, but that is for those who may not be aware, that's a required minimum distribution. which now, tell me if I'm wrong, laws keep changing, starts at the age of 73. But talk us through this, Kelly.
So Adam talked about positive way of framing. I think RMD is a counterproductive way of framing things. So required minimum distribution, the government is simply trying to tax the money that had not been taxed. But many people who are not as financially savvy may not know that, and they see it as a guidance on how much they can prudently withdraw from their retirement portfolio. And we see this behavior happening when we look at the IRA accounts that we have access to look at what type of withdrawal people are taking. So if you look at the pie chart over on the left, 8 out of 10 people didn't take any money out from their IRAs until they hit the RMD age. And once they hit the RMD age, 9 out of 10, 84% were following RMD to a T. RMD is based on a formula. It's 1 over remaining life expectancy, and people were taking just that money out. And if we flip to the next page, I want to show you what the outcome of the RMD is. If you look at the yellow line, that is showing the income that can be generated from a $100,000 portfolio. And you see that it's going up over the years. But that's not how people actually spend. And we'll talk about this a little bit more as we go through the presentation. But we see in the way people spend in retirement to be people spend more in the earlier part of retirement because you're healthier, you now have the time that you didn't have while you're working. So people are out there spending money. And then as we get older, we just become physically less active. So we end up spending money less. So what the blue shaded area on this chart is showing is how we actually spend our money, but RMD actually does the complete opposite of going the other way. So RMD, when it's framed as this is something you have to do by the government, people see it as maybe government is giving me a guidance, but it really isn't. So I think we need to do a better job as the industry in educating people around what the withdrawal strategy that they want to employ may be and how RMD comes in, because that is a requirement from the tax standpoint, not from the financial planning standpoint.
Good. And we will get into recency bias in just a minute. By the way, this is the one I think I face most as an advisor in this role. So I want to spend a little bit of time on that. But before we do, Joanna is behind the scenes. Joanna, if you will launch poll question number 1. This is our fun little interactive piece to the webinar. So that's going to open now. And it says, let me get close to the screen. How do you feel about investing in the stock market now? Worried, neutral, or optimistic? Kelly, how do you feel about it?
Worried.
and is that always your answer?
No, not always. And I was actually trying to click on it and it says poll in progress for attendees only. So it didn't work for me.
No, you didn't get this. Okay, got it. All right, we're going to launch the results there. And optimistic is right there with neutral, and worried is the lowest percentage. So maybe that's a good sign for all of us.
Yeah, people are feeling optimistic. That's great.
That's right. So let's get into recency bias. Adam, we'll start with you to take us through this.
So first, I'll just comment quickly on the poll results. I'm a little surprised and impressed that so many people were neutral and optimistic. We must have a lot of plan sponsors on the call that might have just done their latest plan review and have had advisors like us tell us how good times typically follow bad times. But there's a really neat University of Michigan poll that comes out every month that measures consumer sentiment. And so when it's come out the last 2 quarters, consumer sentiment is actually the lowest it has been since both COVID and the 2007-2008 financial crisis. And so I think that really speaks to recency bias, where you give a little bit more weight to what just happened. And so, in a year when stocks were down 18%, bonds were down 13%, people saw a lot of negative numbers on their statements. A lot of people were taking that and trying to extrapolate that into the future, saying, well, if things just performed poorly, will that continue? And so I'll speak to any football fans we have on the call. But of course, the Kansas City Chiefs won the Super Bowl last year. And so just for fun, I was Googling this morning and I said, what team has the highest likelihood of winning the Super Bowl this year? And lo and behold, the Kansas City Chiefs are favored to win once again for this coming year. And so it's pretty rare for teams to go back to back or repeat championships, but those odds, those probabilities speak to the fact that people say, hey, they just won, they're a good team, they're probably going to win again. And so applying that to the stock market, we just had a bad year. A lot of people are thinking, hey, will this continue? And so that really illustrates the importance of, maintaining your strategy, having diversification, leaning on your providers to reach out to get help. But when you have those, those doubts or those thoughts to saying, hey, will this continue? I'm not sure. Tell me a little bit more. How should I be positioned so that you don't miss out on that rebound whenever it does occur? Because again, often those best times do come immediately after those worst times.
Right. And the plan sponsors on the call, at least in my experience, I think participants come to you first, right? And they're panicked or they're worried about something, and they're talking to you, and then you probably direct them to somebody like us or like Kelly or whoever is an advisor on the plan. And Adam, I don't know about you, but I've had so many conversations over the last 12 months with people who are talking about cashing out or moving to cash because of how worried they are, right? And so they're going to eat a significant loss and not be able to come out of that because of this recency bias and their fear towards the market. And so whether it's us or anybody else that's an advisor on the plan, it's really important to be visible to these participants right now and try to educate them on why that's a bad idea.
Definitely. And it is interesting how quickly those conversations have changed, because it wasn't that long ago that we had people feeling the exact opposite. One, and it was, how can I put more in? How can I be more aggressive? And then all of a sudden those tides turn and it's the exact opposite.
Right. Yeah, exactly. And with that, we are going to get into overconfidence bias in just a minute. But if my sheet is correct, we are going to launch poll question number 2 before we do that. And of course, Adam, I believe as you mentioned earlier, none of us suffer from overconfidence bias, so we can get through this one. But poll question number 2, for those on screen with me who can't see this, how would you rate your driving skills? Above average or below average? Adam, I'll put you on the spot here. And by the way, Adam, you were actually below average, just so you know.
Oh, of course it's above average.
And we were speaking with Kelly, who commutes by train. So Kelly, does this even apply to you?
It does, because I gotta go out to the train, and I think I'm like definitely above average, maybe in the superior league.
That's right. Compared to everyone else, of course.
I could do parallel parking, no problem.
That's good. All right, so poll results, and yeah, almost all of us are above average drivers. Of course, when we're at a 4-way stop and somebody can't figure it out, it's the other 3 people who are at fault there. It's certainly not us. So maybe this leads into, Adam, what we're going to talk about in overconfidence bias.
So I love the results of this, and I've seen this question done a few different times, and almost every time the answer comes out, 90% of people are above average drivers and 10% are below average. So kudos to anyone that was bold enough to actually put out there that they're a below average driver and they recognize it. But by the very definition, 50% of the people on this call should be above average, 50% should be below. And so I think the fact that 90% said they're an above average driver really speaks to overconfidence. And so when we're trying to apply this to a 401k plan, a retirement plan, investing, I really see it take 2 different forms. One is, do people think they can pick better investments than an advisor? And then also, can they time the market better than an advisor? And so, thinking back to when times were pretty good in 2021 and the market was really rolling, there were so many people saying, well, should I buy Tesla? Should I buy Bitcoin? Those stocks had recently run up. Again, that's an example of recency bias. But in a rising market, and to think that the stock picks that have just appreciated 10, 20, 30%, that's indicative of any sort of superior stock picking ability. But then, of course, whenever things go the opposite direction, you can kind of see those mechanics change a little bit. And then in terms of timing, you really have to be right twice in order to successfully time the market. It's incredibly difficult. We try to discourage people from trying to time the market because, again, you have to know when to buy in, but also when to sell out. And so if you look at some of these charts down here at the bottom, I'll point to that orange one, which is a 60% stock, 40% bond portfolio. This is somewhere you might want to be when you're approaching retirement. And so if you would have just held that 60-40 portfolio steady over the last 20-ish years, your average return would have been 6.4%. Now keep in mind, you would have gone through September 11th. You would have gone through the financial crisis in 07, 08. You would have gone through the U.S. debt being downgraded in 2011, oil falling down to $26 a barrel in 2015, and even COVID. Through all those different times, your average return would have been 6.4%. But what we see with participants, falling into this overconfidence bias, is the market takes a downturn, and that's when they say, hey, I need to pull the plug, I want to move to cash, and that's really the worst time to do that. And that's why when you look at that average investor, the column in green, we highlighted that the average participant's rate of return is 2.9% when they're trying to do it themselves, again, because they're often to pull the plug at the very worst time once their account has gone down and then miss part of that rebound.
Yeah, and again, we're seeing a lot of that right now. So I'll preach once again, but if you do have an advisor on your account, please be sure they're coming in regularly, or at least visible to your participants, because it can be a big help to them. And Kelly, let's talk a little bit about the spending profile.
I think another way that many people become overconfident is what they're actually able to do in retirement. I think it certainly is the case with my mom, who's in her mid 70s. She thinks she's, a spring chicken. She can do all the things that she was able to do in her 50s and 60s. And my in-laws, they don't want any outside help, like they're in their 80s, right? So there's that overconfidence on how much they can actually do in retirement. But when we look at this profile, and I mentioned this before, in terms of how people actually go about spending their money and their time, is that it actually sort of declines. And that makes sense, right? Because in the earlier part of retirement, you have so many things that you want to do, and you are able to do them. But as we get older, we become physically less able. And then when you look over on the right, when we get into much later in retirement years, there's an uptick in spending that happens that coincides with the greater amount of healthcare that we experience, as well as in some cases, long-term care issues. So what we see from FAs, the financial advisors, when they're advising their clients, what they often do is they sort of flatline aligning the spending. You take the amount of money that you need right at retirement and they grow that by inflation. But that's not how people are actually going to spend. I think that's a little bit of overconfidence that is built in terms of what people can actually do. And that may overshoot the amount of money that people need at retirement to be successful and to have a comparable lifestyle. So it's really important to understand the actual behaviors and how people go through the life cycle in retirement.
Yeah, and that top right with the question mark, we do a lot of financial planning with participants and wealth management clients, and that, to me, that's the biggest part of this chart, right? Because that's the huge unknown that's out there. And so we get a lot of questions about long-term care insurance versus self-insurance, and I won't get into all that, but I saw that caught my eye, Kelly, is the biggest thing we deal with the what ifs with clients. And let's move to loss aversion bias. Before I do, I am launching, I believe, poll question number 3, final poll question. So we'll let that pop up in 1 second. It's open now, and I'll read this off to you all. It says, would you rather, I like this. Okay, would you rather bet with odds of winning $1,500 or losing $1,000? Okay, so that's option 1, I believe. Yes. All right. So Kelly, if you make a bet, you either win 1,500 or lose 1,000, or option 2 is not bet at all. Which would you pick?
I think it depends on the day. I think today, count me out.
Tell you, but between that and your feeling about the market, you're not having a strong morning.
But she is a superior driver.
Yes, that I am. Never doubt that.
Adam, are you a gambler?
Not a gambler, but an investor.
So would you take that bet?
I would.
You would?
I would.
About 75% of people would not take that bet. Adam, explain why we're even talking about taking that bet or not taking that bet.
So this one coincides nicely with loss aversion bias, and you can see a lot of people are so concerned about losing the $1,000, more so than the potential for gaining in a greater amount, $1,500. And so as we think about the stock market, we're certainly not betting in the stock market, we're investing, but the stock market actually has very similar, I'll say, odds, in that the upside is greater than the downside. If you look at the average return in the stock market for a given year, it skews positive. There are, of course, negative years, but more often than not, the odds are in your favor to have a positive return. And so setting that question up was pretty interesting in that it is very similar to how, the results you might get when you invest, but people are more focused on not losing money than they are necessarily gaining money. So as we apply this to retirement savings, I think this really speaks to asset allocation, trying to figure out what is your ideal risk profile. And you want to have those conversations when times are good. So when the market has really rallied, when things are significantly positive, you want to see your now higher account value and then project what is that going to look like when times get bad? Because we know that's going to happen. We're going to have good times and bad times. And let's make sure we're ready for those bad times whenever they do occur. And unfortunately, all too often what we see is, people kind of just cruise through the good times, but then whenever things get really bad and they see that large negative number on a statement, that's when they realize that their risk tolerance, maybe they've been a little bit more aggressive than they're really comfortable with, and that can lead you to panicking and wanting to sell out. So if you have that conversation on the front end and get to a spot where you're comfortable through both good and bad times, it definitely makes those bad times a little bit more palatable. And so this is a chart here on the bottom that we can sometimes run through with clients to show, hey, in any one year, the numbers on the left, your range of outcomes is pretty wide. It's like asking the weatherman, what's the weather going to be like today? And they say, hey, it's either going to rain or be sunny. It doesn't really take a genius to tell you that. But as you look a little bit further out, numbers on the right-hand side, the range actually gets pretty small and markets become pretty predictable. And so we'll tell people, hey, this is what you can expect over long periods of time. Here's the good and the bad, but let's also be comfortable with the year-by-year results so that when those bad years occur, we're expecting them, we know what they're going to look like, and we don't have that tendency to want to sell out.
And before we get into some emergency reserves, there was a comment that came in that I just missed earlier that was submitted by Scott, and it says it was going back to optimism, whether we're optimistic or not about markets. And he said, I'm optimistic because I'm buying cheap whenever I can. And that's a message we preach a lot as we're talking about financial planning, right? Because while we might have some uneasiness about right now, if we've got a 10, 20, 30-year outlook, Scott's exactly right. We're buying on sale if history proves to be true that over those times we're going to perform really well. So I just wanted to point that out because that's something that we constantly talk to participants about is don't focus so much on the next 6 months. Matter of fact, don't even worry about the next 6 months. Let's look at the future and what this means for your retirement. And with that, Kelly, let's move into some emergency reserves slides.
Yes, I think this is so critical because in order to ride out market volatility, if we don't have cash that's sitting on the sidelines, I think people would get more nervous because they need to generate money to be able to pay for things. So that's why it's so important that people have annual emergency reserves to help them navigate the inevitable spending shocks and income shocks that everyone will encounter throughout the years. But the general rule of thumb in the industry in terms of how much cash is really enough has been rather large, anywhere between 3 to 6 months. And when you think about a number like 6 months, setting aside half of your annual salary in a cash reserve, that's a really daunting task for many people. And we heard that loud and clear from many clients that we talked to. So we were curious to see whether, that had any bearing, is at the right number, by looking at the behaviors within the Chase consumer data of looking at people, workers between ages 25 and 64 and retirees who are older than 65. And what we found was that for workers, the number was a lot lower. It could be anywhere between 2 to 3 months. And here we're showing the distribution from the median, the blue diamond on the bottom, and the 75th percentile with the green diamond at the top. And that was accounting for about once a quarter spending shock that people encounter, as well as some income shock that people endure. But when you look at retirees, those who are, older than 65, what we saw was that the range of outcome was wider, and that coincided with the healthcare that we talked about. As we get older, we can't really predict when we're going to have health events, but when those health events do occur, they can be pretty large in magnitude, and that's why the amount of cash that we need to set aside to navigate the volatility that we see has to be larger for retirees. And then if we go to the next page,
which I love this title, by the way. For those on the call who don't know, we hear a lot about on the investment side, do I just put all cash in at once, or do I got dollar cost average, which is putting in over time? On this slide, we're going to be talking about withdrawals, but I love the title of this, Kelly, dollar cost ravaging.
That's something that we do not want to do. We don't want to ravage our portfolio. What we're trying to illustrate here is the importance of having a prudent asset allocation going into retirement so that people are not so skittish when the market downturn happens because of the loss aversion that Adam walked through. So what this chart is illustrating is if you retire and the market that you expect in the initial part of your retirement is performing, poorly, and you have a static amount of money that you want to withdraw from your portfolio, is the sequence of return risk that can ravage the portfolio. So if you look at the green line at the top, assuming you have $1 million portfolio and assuming the rate of return, the historical rate of return from 1966 through 2000 as follows on the bottom, what happens to the portfolio is that it is depleted by the time this person gets to age 89. And that is too short of a window to have the portfolio last that little of the time because the increased longevity that we're expecting. And the reason we picked the time period on the bottom, the late 60s, is because it's very similar to what we're going through right now in that inflation is soaring, the rate is increasing, and if you look at the bars, the stock market was underperforming. So it's a very similar environment to what we're experiencing for the retirees. So that's why it's important for people to enter retirement with proper asset allocation to help them mitigate the loss aversion.
All right, let's move into our final bias of the 6, I think, biases we've covered, and this is the status quo bias. Adam, I'll let you kick us off with this.
Yeah, and I'm guilty of this one, like many participants. But inertia is really strong, and so once you start doing things or get down a certain path, it's really hard to then revisit that decision, perhaps reverse course. And I mean, let's face it, life is pretty busy, so there's a lot of things competing for your time and attention. You don't always have the time to revisit every decision and basically start from square one. So this is where there's a lot of plan design elements or investment options you can utilize to actually have this work in participants' favor. The first one is target date funds. That has overwhelmingly become the default investment option for a lot of retirement plans, specifically because participants are auto-enrolled into it or defaulted into it if they don't choose something different. But then rather than have the investments remain static, you stay in the same investment, but that investment changes over time. So it starts off very aggressive for younger folks, and then as time goes on and they get closer to retirement, it becomes a lot more stable or conservative without them having to do anything. And so that can really help with loss aversion as well, because again, then that person, perhaps they're age 64, they're considering retiring at age 65, the market drops 18% like it did last year, and they're not panicking because their investments have automatically gotten more conservative. Switching gears to plan design. We were given a lot of help with this in 2006 with the Pension Protection Act, but this is where plan design options like automatic enrollment, automatic escalation, we can see some of this on the next slide,
Sure.
Can really help participants enhance their savings without them having to take any action. So if you look at traditional plan design where a participant has to opt in to participate, we know that some folks are going to do that, but we know a lot of other folks are just going to let inertia take its course and forget to turn in that piece of paper, forget to actually start contributing. So automatic enrollment flips that upside down and says you will be automatic enrolled unless you turn in that piece of paper. You always have full control. You can opt out at any time, but unless you take action, you will participate in the plan. And so that's really good at helping people to get started. But then a really powerful combination is when you can combine that with automatic escalation, where perhaps you are auto enrolled at 3 or 4%. Each year you bump that up by 1%. And then over the next few years, you get to that recommended 10 to 15% of savings without you having to take any action. So this could be a way the plan sponsors help participants. If you look at those two images up there, you can see the opt-out rates are relatively low. Typically 80–90% of people, if you auto enroll them, will not opt out. They'll stay in the program. And then only 1 in 5 participants will actually opt out of automatic escalation. And then looking at the bottom chart, you can see what a huge difference that can really make in terms of the ending balance for a participant. The example here is if you didn't do auto escalation, the person after 40 years would have 450,000. But by adding that 1% each year up to a cap of say 10%, that almost doubles the amount that they have in retirement savings. And again, all of this happened without the participant having to take any action. It was built in to the retirement plan.
I like that chart a lot, Adam. It really kind of tells a story about how impactful this can be to the participant, but also the plan sponsors on the call, and understanding the difference that we can make as excuse me, as administrators and as sponsors for this. Adam, I had a question come in while you were talking about this one. This is somebody who tries not to look at their account for the obvious reasons of, don't panic, right? Especially over the last 12 months. But they're asking, in order to avoid status quo bias, how often should they check their 401k account?
That's a really great question. I would say at least once a year, just to check in on the numbers, perhaps make sure that, you're contributing enough to get the full match, or 10 to 15%. And then life happens. So, you might have had children, you might have gotten married, you could have had other life events, you could have had parents pass away, and you're reevaluating kind of your own life circumstances. So I think doing that once a year is a good balance between, am I still on track, or do I need to make any changes without necessarily getting too freaked out by the market? But on the other end, I certainly wouldn't check every day, just because that's going to get you dizzy with the ups and downs, and perhaps let you focus a little bit too much on those down days when they occur.
That's right. And Kelly, I like the next slide. I'll have you talk through this, but it's talking about post-retirement and people, whether they're taking money or leaving it in the plan.
Yeah, this is really interesting. I think we're starting to see the behavioral change. And what I mean by that is more and more people are staying in their employer sponsor DC plan after retiring. So if you look at the concentric circles, the innermost circle is the earliest study that we published, it's 20%. And now you go out and you see that it's 4 out of 10 people who are remaining in their plans. I think there are many factors that drive this behavior. One could be that the plan sponsors want to maintain the scale within their plan and is making it easier for the participants to remain in their plans. And perhaps many of the participants aren't the target client segment for many advisors who are trying to pull the money out. But the other factor could be that it's just easier for you to do nothing, right? The status quo that Adam talked about. So I think there are many drivers behind this trend, but what we clearly see is that more and more people are staying in their DC. But still, the vast majority, 6 out of 10 right now, are leaving their plans. And what do they do when they leave their plans? If we go to the next page, we looked at how people were changing their asset allocation. I think this proves to be like a pivotal point, as Adam mentioned. When things change in your life, then you review your asset allocation, or you review your portfolio, and people are doing that as part of rollover into an IRA. And what we saw in terms of the asset allocation change going from 401k to an IRA is that many people tended to de-risk. It was 3 out of 4 households that de-risked their portfolio. And when they de-risked, the median percentage of de-risking was really large at 17%. And if you look at the chart over on the right, we now bifurcated what we saw on the left, but based on the starting point of how aggressive you were in your 401k. So it could be anywhere between 5% reduction of equity for people who had between 40 to 60% equity to start with, but people who were really aggressive, having more than 80% equity in their 401k accounts, they were reducing their equity percentage by close to 40% at the median level. So clearly, people are reviewing their asset allocation and deciding what their risk tolerance should be, right, as part of rolling over into an IRA. But I wonder what's happening with 4 out of 10 people who are remaining in their plan. Is it easier for them to just simply remain in DC? And if so, are they just remaining in the same asset allocation without reviewing their life circumstances and what they need to fund in retirement?
And one question I wanted to get to before we wrap up, Adam, I'll direct this to you. Kelly, I think this came in when you gave the hypothetical of, if we're expecting a recession to come earlier in the presentation. So the question is, if I think a recession is coming, doesn't it make sense to move out of stocks to avoid the drop? And Adam, this is, I think most of us, Kelly, I won't speak for you and JP, but I think a lot of us in this field do expect a recession to be called in 2023 or 2024. People can debate that certainly, but Adam, you want to answer that question?
Yeah, well, of course, none of us have that crystal ball. If we did, the decision would be pretty easy. Of course, you move out and then you move back in at the moment when you know the market's going to rebound. But timing those two is pretty difficult, and so we would recommend people not try to make that timing decision. And then an interesting point is that a recession can be very different than how the stock market performs. So the stock market is a leading indicator where we might not know we're in a recession until maybe a couple months after we've already encountered that. And so you think to COVID, for an example, the markets dropped 34% from February until March 23rd of 2020. So things still felt pretty scary as of March 23rd, 2020, but that was the moment when the stock market started its 55% climb to ultimately finish the year up 18%. So if you're reading headlines or getting concerned about a recession or the market declining, probably the best advice, it seems counterintuitive, is to just stay put and take the good with the bad, knowing that markets more often skew positively and there will be more good times than bad times. Trying to time those is incredibly difficult.
It is, and typically they run up pretty fast once they start to run, as you just mentioned. But in almost all recessionary periods, by the time a recession is actually called, markets have already kind of coming out of that, right? So from a market standpoint, Adam or Kelly, tell me if I'm wrong, it feels like we have been in a recession, right? As it relates to markets, we're coming out. What it means for businesses and industries, that's going to be different for everyone. So I won't even try to get into that.
And it is pretty interesting that there's not a lot of negative headlines out there about the market, but we're up 7 to 8% this year already. So that does speak to the fact that, just because there's talks of a recession, that could mean a very different result for the actual market performance.
And your clients are up over 20%, right, Adam?
What's that?
Your clients are up over 20% on the year, right?
Oh, at least 30.
Sorry, Kelly, go ahead.
Can I give you my money?
We appreciate your time more.
Yeah, I was just going to say that I think that's why it's important to have an objective for the investment as opposed to trying to trade in and out of the market, given what's happening on a month-to-month basis, quarter-to-quarter basis. If you have an objective that you're trying to accomplish and building a portfolio around it is going to result in a much superior outcome than trying to, time the market.
Yeah, exactly right. And with that, we will wrap up. We have not introduced yet our next topic and date for Retirement Plan Academy, but be on the lookout for that. We will post it. You see a website there, thetrust.com/RPA. Kelly, thank you so much. It's great to have your expertise on here. And Adam, wonderful job as always. Really appreciate the two of you. And to everybody on the call, thanks for being here with us today, and we will see you soon.
Thank you.
Thank you.